how has this affected your response to portfolios? Are you doing anything differently?
We've been concentrating our portfolios towards our highest conviction names, and so we haven't done anything different. And the reason for that is the innovation that we're investing in is following learning curves that are dropping costs and prices and increasing the access to these technologies throughout the world. So they are scaling exponentially, and we just want to be there for the ride.
So there's some concerns that maybe the downside volatility been driven by deterioration in the underlying fundamentals of your holdings.
Well, no, although those who tag our portfolios with the stay-at-home description would suggest that there's decelerating growth and that it probably will not pick back up. That was a once-in-a-lifetime opportunity, pulled a lot of business ahead. And we think that this year, now that we are getting through the toughest comparisons in terms of the coronavirus, when consumers and businesses were adopting technologies aggressively to solve some big problems they were encountering, now that we're passing through the toughest comparisons, we think this controversy will be put to bed, because as we cycle through, we believe their growth rates are going to accelerate.
I remember talking to you about this pre-pandemic, and then throughout this pandemic 2 years that we've had, you would bring up different companies like Teladoc, for example, and the story just kept getting stronger and stronger. Maybe use that as an example.
Sure, I'd love to. So Teladoc is now in our top 5, as is Zoom and Roku. These would fall into the stay-at-home stock category. And we've been increasing our position as we've been concentrating our portfolio. And just to refresh your memory, the reason we concentrate our portfolios is because during risk-off periods, most investors and analysts diversify their portfolios and get closer to their benchmarks, the benchmarks against which they're measured. We do not have any one benchmark. That's not what we do. What we do is buy the stocks that they are selling, because very often in our portfolios, the stocks are either small positions in indexes or they're not in indexes. Our active share relative to NASDAQ or S&P is in the 3 to 6% range. So very few stocks in our portfolios are in the indexes. As investors are selling those shares, again, a decision just to get closer to their benchmark, we're buying them and concentrating our portfolios towards our highest conviction name.
So, Cathie, let's switch gears for a second. You touched a little bit on Teladoc. Healthcare and genomics names were hit particularly hard in the last 12 months. Talk about that space, and are you still excited about it?
We couldn't be more excited. The space went into a little bit more of a tailspin this week after the JP Morgan conference. And the purported reason for that was, we didn't get any real M&A out of this. This is usually when big announcements are made, and typically there are a few very good M&A events. So what we're dealing here with is really the longest duration stocks in our portfolio. And if you've been watching, we are continuing to add to these names every time they come down. Now, many of these names, again, you've got algorithms at work, and you've got an inflation fear out there, which many people think means higher interest rates, And interestingly, long-term interest rates are not confirming that, by the way. And we do believe inflation is transitory. I know that's become a bad word recently, but we believe people are going to be shocked at how low inflation goes this year. We're going to see negative year over year in many, many categories. Today's retail sales report proves that out.
So if an advisor who invested their client's money in your ETFs or an individual investor bought your ETFs, I mean, succinctly, what would you tell them? What advice would you give them?
Well, there's tremendous change on the way, and we know it. We're seeing it in our lives. The ground is shifting underneath us, and it is because of these innovation platforms. The most important thing is to get and stay on the right side of change. Now, what does that mean in terms of portfolio construction? Do you want to go 100% into a strategy like ours? Well, most, given the volatility, cannot do that. I might do that personally, and I have a majority of my financial wealth in our strategies. And that's because of the conviction I have in them on a 5-year basis. But just let's take the more risk-averse investor. If we're right, and there's going to be a lot of creative destruction out there, there are going to be a lot more IBMs and GEs. Again, they were never supposed to have failed as spectacularly as they have in terms of their promise. If we're right, then even the conservative investors need a hedge against that possibility. Our portfolios are a great hedge, and we have a white paper on our site about how adding our portfolio to traditional growth and value portfolios, 5 to 10%, I think, would have increased returns, and relative to just the plain vanilla value growth, would have increased returns and lowered volatility, because the correlation of our returns, and you can see it in the last couple of years, the correlation of our returns to the traditional benchmarks has been very low. Last year it was negative, the year before it was positive, but over time, very low correlation of returns. And so we know that most of our clients that are advised by RIAs have exposure in, I think it's below 10%, and I think most below 5%. I certainly would be using this downdraft to increase that allocation, because if anything during the last year, and it is quite a year for me to be saying this, if anything,